Welcome back to episode 5 of our Options Market Mechanics Explainer. Today, we're making a massive pivot. We are officially transitioning away from theoretical Greeks and diving straight into actual tape forensics. Up until now, we focused heavily on the machine itself, the dealers and the forces acting on their hedges. But today, we cover how you can stop guessing on market direction and start reading genuine raw market positioning. Here's the forensic funnel running through today. First, volume versus open interest. Second, reading put/call extremes. Third, filtering unusual activity. And finally, profiling market participants. Let's get right into it. Section 1, volume versus open interest. We need to figure out exactly how to tell if we're looking at new money or old money. Okay, we really have to start by redefining what flow actually means. Seeing thousands of contracts print on your screen is completely useless unless you can actually tell if it represents new risk or if it's just someone taking profits. You see, volume just represents today's prints. But if that heavy volume is pairing with open interest, or OI, actually falling the very next day, well, that's merely closing flow. It's an unwind. It's old news. Opening flow, on the other hand, is what indicates fresh, new positioning hitting the tape. Now, here is your absolute golden rule for spotting that new money. When daily volume at a specific strike is more than 2 times the existing open interest, you are looking at the definitive footprint of fresh money. Think about it. If a strike has an OI of 1,000 and 3,000 contracts trade today, it's a mathematical certainty that new positions are opening. Seriously, this is one of the most information-rich signals you'll ever find on the tape. Moving to Section 2, reading put/call extremes, and how to separate the actual signal from all the noise. A lot of traders look at a put/call ratio of 0.9 or maybe 1.1 and treat it as a signal. It isn't. The middle of this range is total noise. You have to look at the mechanics behind the extremes. A ratio over 1.5 doesn't just mean there's fear in the market, it means fear is completely saturated. Everyone who wants a hedge already bought one. That creates a brilliant contrarian bullish setup because those puts become mechanical fuel for buybacks via charm and vanna. Conversely, a ratio under 0.5 signals this really fragile euphoria. It leaves dealers heavily short calls, which effectively hard caps any potential rallies. Section 3, filtering unusual options activity. Let's find those real footprints. Look, about 90% of the unusual options activity alerts you see are just expensive noise. To track real conviction, you have to differentiate exactly how that volume is hitting the tape. First, we have blocks. These are single, large, negotiated institutional prints. A 5,000 lot block is a highly calculated, strategic decision. Then you have sweeps. This is where an urgent order is literally smashed through multiple exchange offers simultaneously. The buyer doesn't care about finesse at all. They're aggressively paying up to get filled immediately. But volume and urgency by themselves aren't enough. You absolutely must pair this activity with implied volatility. If IV is rising alongside heavy volume, buyers are aggressively lifting offers, meaning they're willing to pay the premium. But heavy volume with falling IV? That just means sellers are passively hitting bids. What we want to see are aggressive opening buys, which means IVs simply must be taking up with the flow. So here is your mandatory 5-step filter stack to find genuine tradable activity. 1. It has to be opening flow, meaning volume is over 2 times OI. 2. It's got to be urgent, executed via sweeps. 3. Heavily sized. 4. No event. If earnings are coming up in 3 days, that's just event positioning, not a real directional conviction. And 5, no spread. It needs to be a standalone, directional bet without a matching spread at other strikes. When a flow meets all 5 of these criteria, you've got an honest tell of informed positioning. All right, Section 4, profiling market participants. We need to know exactly who is doing what. You should never, ever trade an aggregate signal without asking exactly who is behind it. Basically, there are 3 main actors moving the tape. First, dealers and market makers. Keep in mind, they have absolutely no opinion. They're just a pure hedging mechanism. Second, institutions. Their flows are slow, very persistent, and heavily focused on downside put protection. They're the ones shaping the volatility skew. Third, retail and speculators. Their flow is urgent. They constantly chase short-dated, out-of-the-money calls, and they basically just create fragile squeeze fuel. And this distinction perfectly illustrates the ultimate trap when looking at sentiment data. When you're trying to gauge if a trade is crowded, you have to actively distinguish between headcount crowding and capital crowding. Headcount crowding is just thousands of tiny retail accounts all leaning the exact same way. Capital crowding, though, is where serious, market-moving institutional money is actually positioned. When the position-weighted capital strongly diverges from the retail headcount, that divergence itself is a massive actionable signal. So, to wrap up today's explainer, I want to leave you with this thought before your next session at the screens. After applying this entire forensic filter stack, checking opening volume versus OI, filtering out events, distinguishing sweeps, and identifying the exact participants, ask yourself, is your current options flow tool genuinely giving you a mechanical edge, or are you just paying to see the noise? The market literally stops looking random once you learn to read the real footprints. Take these filters, apply them tomorrow, and just watch how the game changes for you.